Investors, just a couple of weeks ago, I made a video about Realty Income and made the case for why this REIT is still a buy. Yet it's only plummeted to lower lows, and a matter of fact by roughly 7.35% deeper into the red within the last 5 days alone.
That's right! We can't have anyone freak out there, okay? We've got to keep our composure! We've come too far! There's too much to lose! We've got to keep our composure!
So here I am yet again saying Realty Income is still a stock worth loading up on if you're looking for the perfect monthly paying dividend stock to invest in. With that, let's get right to it. So just to make sure we are all on the same page here when it comes to Realty Income, I want everyone to recognize the fact that we are not just talking about your run-of-the-mill real estate investment trust, but rather the largest single client property landlord within the United States with a growing presence internationally as well. Now, all in, Realty Income is spanning 255 plus million square feet of leasable space across 13,000 commercial properties under long-term net lease agreements with quite a fortified income stream thanks to their diversified portfolio worth of clientele equating to over 1,300 clients. But yet, it's still being rocked by all of the market fears, especially as investors begin to fret about interest rates. Now, honestly, there's a good reason to worry about the implications of higher and higher interest rates if you're not in the know about the businesses that you've been investing into. Now, we all know when interest rates hit near zero a few years ago, businesses, especially REITs, were off to the races given their easy access to capital and cheap debt. But all good times must eventually come to an end, and that end is now. However, Realty Income is positioned far differently than its peers. I mean, for one thing, let's just recall that Realty Income was the REIT that over the last year magically paid down balances of around $2.7 billion to around $990 million. Even if it was in the same exact economic environment as other REITs, it performed far better. Now, what I really want to focus on is what matters the most when it comes to the future of Realty Income for dividend investors, and I want to do so through the lens of the real estate perspective because that was, after all, my background when I lived in Manhattan. So we're going to go ahead and look into their business model as well as their properties before coming to understand what matters the most, their debt. Because in the most simplistic of terms for all of us to understand, a healthy business is when you have more assets to cover all of the liabilities. But before we go any further here, if this video is bringing you any value, I want to ask for your help in letting me know. That's all you have to do is simply tap on that thumbs up button to let me know, and I'll keep creating content just like this. With that, let's chat about Realty Income's business model, to which we can throw this term net lease around. And you need to understand that a net lease means an agreement to which the tenant who leases out a property is then liable for all expenses related to the property, whether it's maintenance, upkeep, taxes, or anything in between. And now, in other words, Realty Income isn't paying a penny on these properties once they're actually leased out. Now, more importantly, we have to look into the types of properties being impacted the most and which property type is the riskiest. Now, when it comes to Realty Income, their properties are there for retailers as well as industrial spaces, 82% and roughly 13% respectively. So clients like 7-Eleven, Dollar General, Walmart, CVS, or on the industrial front, we're talking about space for, say, their clients like FedEx. Now, in other words, Realty Income is not exposed to the same troublesome headwinds as some of these other REITs. And that's just within the nature of their properties and clients. We're talking about those REITs that are more oriented towards office spaces. And when they did acquire such space with their REIT, well, they sold out of the properties. But now let's look into the financials here for a quick second to discover $49.67 billion in assets versus their $20.8 billion in liabilities. Now that makes for a cool $28.87 billion difference to shore up any potential pockets of trouble, and having a glance at these metrics over time, a standout job over the years consistently delivering through on debt management. However, I do want you to take note of another move that the company recently made, which was issuing about $48 million in shares of common stock, which also spooked away a lot of investors and leaves many questioning. But again, I always revert back to the Realty Income team. And looking ahead in the future is what we all need to be doing, focusing on the company as they continue to expand a part of their rationale for issuing those shares to afford more properties. Meanwhile, we have plenty of strong indicators here, like insiders buying more shares, as well as hedge funds placing their bets on Realty Income. Now, as for analysts, Plenty of top analysts remain bullish, with over 39% worth of upside coming to a share price of $69.88. But now when it comes to Realty Income, we are of course all here for the dividends on a monthly basis, to which I'm certain Realty Income will continue to deliver through on dividends after 25 plus years worth of growth at a 5-year rate of 3.71%, along with a strong 6.11% dividend yield to get that annual payout of $3.07. And note their ex-dividend date as well is coming up on the 29th, so hopefully you can all catch it. Now investors, let me know your thoughts on Realty Income down in a comment below, whether you are buying more shares, holding, or you are about ready to sell. Now also be sure to check out this video right here for more stock ideas, but before you do, be sure to subscribe to never miss a single video.